Hey everyone, happy Thursday, January 22nd, a little bit before 11 a.m. on the West Coast, and it's time for another market update. Well, going back to last week, rates were kind of heading in the right direction. They had announced, President Trump announced they're going to be buying some bonds. That had the markets feeling good. However, we got some new drama heading into the weekend, and that had to do with Greenland. I'm sure you heard on the news. President Trump had said that we really want Greenland for security reasons. That caused a lot of drama. The European countries did not like that. And like I tell people, the markets did not like that because what the markets like is calmness. They don't want volatility. They don't want craziness. They want to be able to know what's going to happen so then they could put their money into things and make money and not be worried that crazy things are going to make them lose their money. So just on that alone, any sort of upheaval, volatility, the markets generally are not going to like, and the markets definitely did not like this. Like we talked about, mortgage rates, the average conventional rate had dropped down to 6.01, even actually 5.99 at one point that day. Last week when we talked, it had jumped up to 6.07. And off of this, it almost jumped a little bit under a quarter of a point. Just based on this. And I'm sure those of you who have crypto or stocks also saw those take a hit. The last couple of days, there's been some positivity. They backed off a little bit on those things. Treasury Secretary Bessent made the markets feel a little better. So we've recovered some of those losses, but not all the way back to where we were before then because we're still unsure if there'll be new tariffs, what will end up happening there. And again, tariffs are only a one-time hit, but we're just kind of wrapping up the tariffs that we did before, where there's going to fall out of inflation and make inflation numbers better. So if we did new tariffs, then that would just kind of set that clock back. We'd have another year or so of that one-time hit kind of showing up in those inflation numbers. And like we've talked about, the Fed does not like high inflation. So the lower inflation goes, the better for us, the better mortgage rates will go. So drama, no good. This whole Greenland thing, not a political thing, but any sort of volatility, the markets are not going to like. And then there was also some volatility in Japan, which also had a negative effect, but that seems like that's calming down a bit too. Next thing. So speaking of inflation, we got the delayed data for both October and November PCE. This is the Fed's favorite form of inflation. And these are the November numbers, and it came at 2.8. What actually happened, the October numbers came out first, and those both came at 2.7. Markets like that because it was 2.8 previously, going back to September. And then this one came out for November, and it went back to 2.8. So 2.8 to 2.7, and now back to 2.8. So the markets are pretty sideways today. This wasn't, a great report. It also wasn't a negative report. But as you can see, the annualized core run rate is for 3 months is down to 2.2. So that's getting, if that 3.2, or I'm sorry, 2.2 continues out over a year, that's a lot closer to what the Fed wants. The Fed wants that core rate, which takes out food and energy costs because they think those are the things they do not have control over in our economy. Their target is 2% for that core rate. So 2.2 is a lot closer than 2.8, which is what the 12-year month average is currently. So again, not the worst report, but also not the best. Markets are pretty sideways looking at that one. Next thing we got. So this one I want to touch upon. This has more to do with narrative and clickbait headlines and things like that. A couple days ago, there was a lot of headlines about foreclosures jumping 14% year over year in 2025. I saw a lot of media outlets pick this up, a lot of consternation. People, oh no, the housing market's crashing again. Again, let's just keep this in mind. First of all, Adam, ATTOM, who did this report, is often very wrong. I'm sure there are lovely people that work there, but they don't seem to be very accurate with the projections and the things they come out with lately. So that's one thing. Second of all, this is the chart. This is the number of foreclosures, historical foreclosure activity and rates going back to 2005. And as you can see, yes, they went up from 0.23 to 0.26, but that's quite a bit lower than it was during the crash, quite a bit lower than it was pre-pandemic, which we would consider more normal times. So again, they did go up 14% year over year, but 14% from what? Anytime you hear those a month over month or year over year numbers, you always got to look at that. Is, if there was 0 of something last year and it went up to 10, that's not a huge number, but that's going to be a huge percentage increase. And that's kind of what happens with these clickbait articles is they come out with these scare tactics, scaring people away from the housing industry and whatnot, with these huge, foreclosures are up 14%. But again, they're still at historically really, really low levels. So that's something to keep in mind. Sure, don't want to see any more people get foreclosed upon, but overall, the housing market is still looking really strong compared to historically. So next thing, where does that leave us? So like I talked about last week, we're at 6.07. Today we're at 6.19. So we dropped down a little bit from where it jumped up to, I think, 6.21 after the Greenland stuff. So 6.19 is getting further away from 6, where we had got back down to. So it's a little bit more of that, that Greek mythology thing where the person pushing the rock up the hill and then falling back down. And that kind of seems what mortgage rates. We keep pushing that 6 number, and then something happens to push us back up in this case. So 6.19, it'd be nice to see it get back down to that 6.0 number. But again, we got to make sure all this drama goes away in the markets. Next thing, important dates. So coming up next week, the Fed meets again and makes their rate cut announcement. Right now, markets are leaning not for them to make a rate cut, for them to pause. So just keep rates where they're at. But a week to go, and like we talked about, there's a lot of stuff happening out there in the world, so you never know what might change to maybe make the Fed change their mind. But as of now, it doesn't look like they cut. But like we talked about, the markets are not necessarily expecting that. So really, when rates get hurt is when the markets are expecting something and the opposite happens. So as long as the markets were expecting that going into the meeting, then that's already kind of baked into the numbers. It's already kind of been built in. So there shouldn't be a huge change. What could change the markets on that day is what Chairman Powell says at the press conference afterwards, and how he answers questions and things like that. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, I hope you guys have a great week. Thanks a lot, guys.